Investing in the stock market can be a rewarding venture, but it requires a well-thought-out approach and a thorough understanding of different investment strategies. With numerous approaches available, investors can tailor their strategies based on their risk tolerance, investment goals, and market outlook. Here's an in-depth exploration of various investment approaches in the stock market, designed to guide both novice and seasoned investors. 1. Fundamental analysis. Fundamental analysis involves evaluating a company's intrinsic value by examining related economic, financial, and other qualitative and quantitative factors. Investors using this approach look at financial statements, management, competitive advantages, industry conditions, and economic factors to assess a company's potential for growth. Key components: financial statements, analysis of balance sheets, income statements, and cash flow statements to understand a company's financial health. Economic indicators, consideration of broader economic factors like interest rates, inflation, and GDP growth that can impact a company's performance. Industry analysis, understanding the dynamics of the industry in which the company operates, including competition and market share. Advantages, provides a comprehensive view of a company's potential. Focuses on long-term value creation. Disadvantages, time-consuming and requires a deep understanding of financial data. May not capture short-term market movements. 2. Technical analysis. Technical analysis involves studying price movements, trading volumes, and historical data to predict future stock price movements. This approach relies on charts and technical indicators to identify patterns and trends. Key tools: charts, line, bar, and candlestick charts to visualize price movements. Indicators: moving averages, relative strength index, RSI, and MACD to identify trends and momentum. Advantages: useful for short-term trading strategies. Helps identify entry and exit points. Disadvantages: does not consider a company's fundamentals. Can be less effective in volatile or unpredictable markets. 3. Value investing. Value investing focuses on finding stocks that are undervalued by the market. Value investors look for companies with strong fundamentals that are trading below their intrinsic value, often due to temporary market conditions. Key principles: margin of safety, investing with a buffer to minimize risk. Intrinsic value, calculating a company's true worth based on fundamentals. Advantages: potential for high returns as the market corrects its valuation. Emphasizes long-term investment horizons. Disadvantages: requires patience and a long-term perspective. Stocks may remain undervalued for extended periods. 4. Growth investing. Growth investing targets companies expected to grow at an above-average rate compared to their industry or the overall market. These companies typically reinvest earnings to fuel expansion rather than paying dividends. Key characteristics: earnings. Growth. Focus on companies with consistent and strong earnings. Growth. Market trends. Investing in sectors or industries with high growth potential. Advantages: potential for substantial capital appreciation. Focuses on innovative and dynamic companies. Disadvantages: higher risk due to premium valuations. Vulnerability to market corrections. 5. Income investing. Income investing prioritizes generating regular income through dividends or interest payments. Investors focus on stocks that offer reliable and attractive dividend yields. Key considerations: dividend yield, the annual dividend payment divided by the stock price. Dividend growth, companies with a history of increasing dividends over time. Advantages: provides a steady income stream, can offer stability in volatile markets. Disadvantages: limited capital appreciation potential. Dividends are not guaranteed and can be cut. 6. Index investing. Index investing involves buying securities that track a market index, such as the S&P 500. This passive investment strategy aims to replicate the performance of the index rather than outperform it. Key features: diversification, exposure to a broad range of stocks within the index. Low costs, lower fees compared to actively managed funds. Advantages: simplifies the investment process. Historically strong long-term returns. Disadvantages: lack of flexibility to outperform the market. Exposure to all sectors, regardless of performance. 7. Contrarian investing. Contrarian investing involves going against prevailing market trends by buying undervalued stocks during market downturns and selling overvalued stocks during market booms. Contrarians believe that market sentiment can lead to mispriced assets. Key insights: market sentiment, understanding the psychology of market participants. Patience, willingness to hold unpopular stocks until the market recognizes their value. Advantages: potential to buy low and sell high. Capitalizes on market inefficiencies. Disadvantages: risk of prolonged underperformance. Requires strong conviction and patience. 8. Momentum investing. Momentum investing capitalizes on the continuation of existing market trends. Momentum investors buy stocks that have shown an upward price trend and sell stocks that have shown a downward trend. Key strategies. Trend. Following: identifying and investing in stocks with strong upward momentum. Relative strength, comparing a stock's performance to the overall market. Advantages: potential for quick gains in trending markets. Focuses on market leaders. Disadvantages: high volatility and risk. Trends can reverse unexpectedly. 9. Dividend growth investing. Dividend growth investing focuses on companies that not only pay dividends but also have a history of increasing their dividend payouts over time. This strategy combines income with potential capital appreciation. Key metrics: payout ratio, the percentage of earnings paid as dividends. Dividend history, consistency and growth of dividend payments. Advantages: growing income stream over time. Potential for capital appreciation. Disadvantages: requires thorough research to identify sustainable growth. Dividends can still be cut in economic downturns. 10. Sector rotation. Sector rotation involves shifting investments between different sectors based on economic cycles and market conditions. This strategy aims to capitalize on the varying performance of sectors during different phases of the economic cycle. Key considerations: economic indicators, understanding how different sectors perform in various economic conditions. Cyclical versus defensive, identifying when to invest in cyclical, growth-oriented, versus defensive, stable sectors. Advantages: potential to outperform the market by capitalizing on sector trends. Diversification across various industries. Disadvantages: requires constant monitoring and analysis. Timing the market can be challenging. 11. Quantitative investing. Quantitative investing uses mathematical models and algorithms to identify investment opportunities. This data-driven approach relies on statistical analysis and computer models to make investment decisions. Key elements: data analysis, using historical data and statistical techniques to identify patterns. Algorithmic trading, automating trades based on quantitative models. Advantages: removes emotional biases from investment decisions. Can process large amounts of data quickly. Disadvantages: models may not account for unforeseen market events. Requires expertise in data analysis and programming. 12. Environmental, social,